Imagine you're like 1,000 feet underwater, just sitting in a nuclear submarine.
Oh, wow. Yeah, that is a terrifying thought.
Right. The pressure outside the hull is just absolutely immense. It's actively trying to crush the vessel at like every single moment.
Or the physics of it are just wild.
Exactly. Or picture a rocket tearing through the upper atmosphere. It's dealing with temperatures that would just melt conventional steel in seconds.
Melts it like butter, yeah.
And when any of us picture those extremes, your mind probably goes straight to the giant prime contractors.
Right, the famous names painted on the side of the hull.
Exactly. We picture those massive metal tubes and just the sheer scale of the operation.
Which makes sense. I mean, it's what we can see.
Yeah, but if you actually look at the engineering, the true marvels aren't just the visible structures.
Oh, absolutely not.
It's the invisible, highly specialized internal components, right? The parts that manage that extreme pressure, the massive heat, and the absolute vacuums of space.
Because, I mean, if one of those invisible parts fails, say like a specialized valve or a heat transfer system, the entire multi-billion-dollar machine fails.
It's gone.
Exactly. It is the hidden anatomy of the infrastructure that absolutely everything relies upon.
So today, we are looking right under the hood of a company that builds those exact invisible parts.
This is going to be a fun one.
I think so too. Our deep dive today is focused on Graham Corporation. They trade on the New York Stock Exchange under the ticker GHM.
Right.
And we are pulling from a couple of sources today, an earnings presentation and a press release, both dated June 8th, 2026.
Fresh data.
Yeah. And so they are a global leader in designing mission-critical technologies for the defense, space, and energy and process industries.
And, the data we're looking at here tells a really fascinating story about scaling an industrial manufacturing business in real time.
Right, because scaling is hard.
Oh, it's incredibly hard. It is one thing to win contracts, right? It is an entirely different beast to physically build the capacity to fulfill them.
Whether you're trying to understand industrial supply chains, or maybe you're just looking for a master class in scaling a manufacturing business, this deep dive is going to deliver those aha moments.
Definitely, especially if you're just curious about how companies actually make money off space and defense.
Okay, let's unpack this. Let's jump right into the sheer scale of the financial year they just reported.
Let's do it.
Because looking at their full fiscal 2026 results, Graham achieved record orders of $359.4 million.
Huge number.
Total revenue hit a record $245.3 million.
Also huge.
But the number that really stopped me in my tracks is their backlog. I mean, it reached $532.6 million.
Yeah, that is a 29% increase year over year, just a staggering amount of future work piled up.
Right.
And to understand the velocity of that growth, you really have to look at their book-to-bill ratio.
Which was 1.5x for the year. Right?
Exactly, 1.5x.
I want to visualize that metric for a second, because 1.5x sounds nice, but what does a 1.5x book-to-go ratio actually look like on a factory floor?
Okay, think of it as a conveyor belt.
Okay.
For every 1 unit of finished product that Graham pushes off the end of the conveyor belt to bill a customer, the sales team is stacking 1.5 new orders onto the front of the belt.
Wow. Okay, so they're bringing in new business significantly faster than they are shipping out completed products.
Precisely. It is a leading indicator of massive future growth, because your production pipeline is just becoming fully saturated.
I mean, that sounds like the ultimate corporate dream scenario.
Oh, absolutely.
You have more demand than you even know what to do with. But I was looking through their gross profit margins, and there is a glaring discrepancy.
Ah, yes. The margin squeeze.
Right. Because if demand is through the roof and the factories are operating at that high volume, shouldn't their profit margins be expanding, due to economies of scale?
You would think so, yeah.
But instead, their gross profit margin actually dropped by 1.7% year over year. It landed at 23.5%.
Yeah.
So what is happening there?
Well, what's fascinating here is that a dropping margin percentage doesn't automatically equal operational failure.
Wait, really?
No, not at all. In fact, Graham's gross profit in actual dollars went up 9%.
Oh, so they actually made more money overall.
Exactly. They made more money. The 1.7% drop in the margin rate is almost entirely a story of what we call product mix.
Meaning Like the specific types of things they are selling changed.
Precisely. The massive revenue spike was heavily driven by the defense sector.
Right.
And in Graham's specific business model, selling new defense components traditionally carries a slightly lower profit margin compared to, say, servicing an existing energy plant.
Oh, like in their aftermarket business.
Right, because defense contracts are incredibly lucrative in terms of sheer volume, but the raw materials cost more.
And I imagine the compliance requirements are way stricter.
Oh, incredibly strict. So the margin percentage on those specific items is just naturally tighter.
Okay, that makes sense. But they also mentioned absorbing about $1 million in tariff impacts.
Right, that classic invisible tax on the supply chain.
Yeah,
Because if the specialty steel or the components you import suddenly cost more due to tariffs.
right. And you're locked into a fixed price government contract.
Exactly. You eat that cost in your margins.
Ouch.
Yeah. And there is one more highly specific detail distorting the math here. A previous grant.
Oh, the Blue Forge Alliance grant.
Yep. In the prior year, Graham received a financial grant from the Blue Forge Alliance specifically for defense welder training initiatives.
Ah, okay. So that grant essentially subsidized their labor costs last year.
Exactly, which made their margins look artificially high back then.
So when you remove that free money from the equation this year, add $1 million in tariffs, and shift the bulk of your sales to heavy material defense contracts.
Your margin percentage mathematically just has to come down, even though the business itself is generating more total cash.
Okay, that makes perfect sense. It's not operational bloat at all. It's just the reality of building heavy defense equipment. Which brings us to the biggest driver of this entire operation. You mentioned defense is driving the volume.
Big time.
Yeah. According to the Q4 backlog, that $532 million pile of future work, 85% of it is strictly defense.
It is the absolute bedrock of their current growth.
And the sources note this is heavily driven by key naval defense platforms.
Right. We are talking about critical fluid, power, and heat transfer systems.
Systems going into submarines and aircraft carriers, right?
Yeah.
I am really trying to wrap my head around the engineering here. Like, what exactly is a heat transfer system doing on a nuclear submarine?
Okay, so think about the physics of a nuclear submarine.
Okay.
You have a nuclear reactor on board, generating immense amounts of thermal energy to propel the vessel.
Right, through the ocean.
But you absolutely cannot have the radioactive water that cools the reactor mixing with the water used to generate steam for the turbines.
Oh, that would be bad.
Very bad. So a heat transfer system, or a heat exchanger, allows the intense thermal energy from the reactor loop to pass through a barrier of highly specialized metal.
To heat up the clean water loop.
Exactly, without the two fluids ever actually touching.
Wow, so the metal separating those fluids has to withstand massive temperature differentials.
Yes, and extreme pressure.
Yeah.
And it has to do it for decades without degrading.
Because if it cracks.
If it cracks, you have a catastrophic radiological event on a deployed military asset.
That is terrifying.
Yeah, the manufacturing tolerances are practically microscopic. You can't just hire a random contractor to weld those parts.
Which explains why a company can't just magically absorb $500 million in new defense work.
Right, you need incredibly sterilized physical space to build this stuff.
And Graham has been pouring concrete to keep up.
They really have. They recently completed a brand new Navy facility in Batavia, New York.
Oh, yes. I'm so glad you brought that up because the financing detail on that facility absolutely blew my mind.
It's wild, isn't it?
It is. So the new facility in Batavia was a $17.6 million expansion.
Yep.
But the company only paid about $4 million of that because $13.5 million was backed by a customer grant.
Right.
I try to picture this in any other industry, and I just can't. Here's where it gets really interesting. It's like, say you own a restaurant,
Okay.
and your food is so critical to one of your regular customers that they literally pay to build you a bigger kitchen, just so you can cook for them faster.
That is a brilliant analogy. It really is a brilliant arrangement.
Feels like a cheat code.
While the prime contractors building these submarines and ultimately the U.S. Navy, they just cannot risk Graham becoming a bottleneck.
Right. Graham is mission-critical infrastructure.
Exactly. If Graham doesn't have the floor space to build the heat exchangers, the entire multi-billion-dollar submarine program just grinds to a halt.
Wow.
So the customer provides the capital to ensure Graham can scale its physical footprint.
From a business strategy standpoint, that is amazing. Because Graham notes in their presentation that they target greater than a 20% return on invested capital, or ROIC, for their organic investments.
Yes. And, think about the math of that Batavia plant.
Okay.
If a facility costs $17 million to build, generating a 20% return on that takes massive sales volume.
Right. That's a lot of heat exchangers.
But if Graham only had to invest about $4 million of their own capital because the customer paid for the rest.
Hitting a 20% return on their own invested capital becomes significantly easier.
Exactly.
And Batavia isn't the only place they are building. The sources highlight a really deliberate nationwide expansion.
Right.
They completed a cryogenic test facility in Jupiter, Florida. They finished a liquid nitrogen testing facility at their Barber-Nichols subsidiary in Arvada, Colorado.
Yep. Plus, they're outfitting automated welding machines.
So they were really busy.
Very busy. But that expansion signals a shift in capability, not just capacity.
Let's look at that shift. Because 85% of the backlog being defense is a massive safety net right now.
Oh, for sure.
But anyone watching industrial trends knows defense budgets can be, cyclical.
Cyclical, yeah.
If you rely entirely on one customer, you are incredibly vulnerable. So how is Graham making sure they aren't completely dependent on naval contracts for the next decade?
Well, by actively building out a stabilized, diversified portfolio.
Okay.
And the most immediate area of aggressive growth is space.
Space.
Yeah. Their space revenue grew 14% in the fourth quarter. But the forward-looking metric is the real story here.
Which is?
Space orders increased by 76% year over year.
A 76% jump in orders. That is massive.
It is. They are clearly gearing up for a massive ramp-up in fiscal 2027.
But what does Graham actually make for the space sector? Like you mentioned the new testing facilities in Florida and Colorado.
Right.
Why does a manufacturer need a cryogenic test facility or, liquid nitrogen testing?
Because space is an incredibly hostile environment.
Fair enough.
I mean, if you launch a satellite or a propulsion system into orbit, it is subjected to temperature extremes that are just hard to comprehend.
Like what kind of extremes?
Well, in direct sunlight, temperatures can soar hundreds of degrees. And then in the shadow of the Earth, they plummet to near absolute zero.
Oh, wow. So conventional materials just, warp or shatter?
Exactly. Metals shrink when they freeze and expand when they heat up.
Right.
So if you are building a pump that moves liquid fuel through a rocket engine, you have to know exactly how those metal seals will behave at minus 300 degrees.
Which I guess you can't just simulate on a computer.
No, absolutely not. You have to physically submerge the components in liquid nitrogen or, put them in a cryogenic chamber.
And test them under those extreme thermal stresses before you ever put them on a rocket.
Precisely.
That makes a lot of sense. You are essentially building a torture chamber for metal to make sure it survives orbit.
That's a great way to put it.
Now, beyond space, they also made a really strategic acquisition. They bought a company called FlakTech.
Yes.
FlakTech.
The sources say FlakTech immediately contributed $2.8 million to Q4 sales.
Right out of the gate.
Right. But what exactly do they do? The phrase used in the sources is advanced mixing and materials processing.
Okay, so by acquiring FlakTech, Graham established a third core technology platform.
Okay, because they already had fluid, power, and heat transfer.
Right. And they had vacuum technologies.
And now they have advanced mixing.
Exactly. And in highly specialized manufacturing like aerospace sealants, advanced adhesives, or even pharmaceutical compounds mixing materials isn't like stirring paint.
Wait, how? So, what's the difference?
Well, imagine you get a microscopic air bubble trapped inside an aerospace sealant.
Okay.
And that sealant goes into a zero-pressure environment in space.
Oh.
That tiny air bubble will expand and blow the seal apart.
Are you serious? Just a tiny bubble?
Just a tiny bubble. So advanced mixing technologies use centrifugal forces to mix viscous materials perfectly homogeneously, removing absolutely all the air voids. I never even considered the danger of an air bubble in a sealant.
Yeah.
That expands their capabilities tremendously.
It really does, and it specifically bolsters their energy and process, or E&P, sector.
Which is an area where they really need that stabilization, right?
Yes. The E&P sector has been facing some very distinct headwinds.
Yeah, the sources mentioned that while there is steady demand for aftermarket servicing, which means fixing and maintaining existing energy plants, the large capital projects in the E&P sector have been delayed.
They have.
Why are energy companies pausing their big investments right now?
If we connect this to the bigger picture, it primarily comes down to ongoing geopolitical uncertainty.
Ah,
Yeah, building a massive new petrochemical plant or a traditional energy facility is a multi-decade commitment. We're talking billions of dollars,
right.
right? So if executives don't have a clear picture of what the global energy market or regulatory environments will look like next year.
They hit pause on the big new builds,
Hmm.
and they just pay to maintain the facilities they already have. That makes total sense. Though the sources specifically highlight new momentum in one very futuristic area of the EMP space.
Yes, small modular nuclear reactors, or SMRs.
We hear that term thrown around a lot lately. Where does Graham actually fit into an SMR?
So SMRs are designed to be built in factories and shipped to locations rather than custom built on site like traditional massive nuclear
Okay,
plants.
making them more modular, hence the name.
Right. But because they are compact, thermal management becomes an incredibly dense engineering challenge.
Oh, because you have all that heat in a tiny space.
Exactly. You have to remove the heat from that reactor core efficiently in a much smaller footprint.
Well, that's where Graham comes in.
Yep. Graham is positioning its heat transfer technologies to be the critical cooling components for this next generation of nuclear power.
Wow. Okay, I want to pause here and look at the financial reality of absolutely everything we just discussed,
Let's do it.
because I'm trying to do the math in my head here.
It's a lot of math.
It is. Building cryogenic test chambers in Florida, outfitting automated welding machines, upgrading software, and buying an entire company in Flagdeck.
Yep.
How does a mid-cap company manage the capital to do all of that simultaneously without taking on just a dangerous mountain of debt?
Well, it requires incredibly deliberate balance sheet management.
Okay.
The physical expansion has to be supported by strategic financial moves, and Graham made a major one right after the fiscal year ended.
What did they do?
In April 2026, which technically falls into the start of their fiscal 2027, they secured a $50 million PIPE investment from accounts advised by T. Rowe Price.
Okay, let's unpack PIPE for a second. That stands for Private Investment in Public Equity.
Correct.
So how does that work normally?
Well, normally, if a public company wants to raise money, they might issue new stock to the open market, which can be messy. It can be volatile.
Right, the stock price can jump around.
Exactly. But in a PIPE deal, a large institutional investor, in this case T. Rowe Price, buys a large block of shares directly from the company in a private arrangement.
Giving Graham an immediate massive cash injection of $50 million.
And honestly, it is a massive vote of confidence from a major institutional player.
Definitely. And Graham didn't just sit on that cash, did they?
Nope. They put it to use immediately. They used $13 million of it to completely repay their outstanding debt.
Wow. So they wiped the slate clean, no more debt weighing down the balance sheet.
They cleared the deck, and that maneuver left them with tremendous liquidity.
Right.
They now have an amended revolving credit agreement giving them access to approximately $74 million.
And their stated goal is to keep their leverage ratio below 3.0x.
Yes. So they effectively have a pristine balance sheet and a war chest ready to fund further acquisitions.
As well as their organic growth.
Exactly.
That completely reframes their forward-looking guidance. The sources lay out their outlook for fiscal 2027, and they are clearly not taking their foot off the gas.
Not at all.
They project net sales between $285 million and $295 million, which at the midpoint, that is an 18% revenue growth.
Right. And they also expect their adjusted EBITDA to be between $35 million and $40 million.
Which is huge.
Yeah, that represents a 44% growth at the midpoint.
So let's clarify EBITDA real quick for anyone who might just look at bottom line profit. Earnings before interest, taxes, depreciation, and amortization.
Right.
Why is that specific metric heavily featured here?
Because Graham is spending so much money building physical things right now. New
Yeah.
buildings, testing chambers, automated welders.
Yeah, tons of capital expenditures.
Then the cost of those physical assets gets depreciated over time, which lowers their standard net income on paper.
Ah, okay.
So EBITDA strips out those accounting variables, giving investors a much clearer picture of the raw cash the actual manufacturing operations are generating day to day.
That makes a lot of sense. And they are aiming to pull those gross margins back up to between 24.5 and 25.5%.
Which is ambitious.
Definitely. But obviously the key to hitting all these financial targets is churning through that massive $532 million backlog.
Yes. This raises an important question about execution.
Right. Because the sources state they expect 35 to 40% of that backlog to convert into recognized sales over the next 12 months.
And another 20 to 25% will convert the year after that?
But like you said, that introduces a massive element of execution risk. Having $500 million in orders on a spreadsheet is a huge victory for the sales team, but actually building it.
Is an entirely different story. It only translates into $290 million in revenue if the supply chain actually holds up.
Right. If they can source the highly specific titanium and specialized metals they need.
And most importantly, it depends on their labor force. Can those specialized welders and engineers seamlessly deliver without bottlenecks?
They even note right in their guidance disclaimer that their expectations assume they can operate at planned capacity without global supply chain disruptions.
Which is a bold assumption.
Yeah, in the 2020s, assuming a flawless global supply chain feels like a pretty precarious bet.
Which is exactly why they are investing so heavily in things like automated welding machines and upgrading their ERP software systems.
Let's talk about the ERP system,
Yeah.
because we hear companies talk about upgrading enterprise resource planning software all the time.
Constantly, yeah.
But what does that actually mean on the factory floor, like day to day?
So an ERP system is essentially the digital nervous system of a manufacturing plant.
Okay.
When you have a $532 million backlog, you are dealing with millions of individual, highly regulated parts.
Right.
The ERP software tracks a piece of specialty steel from the moment it arrives at the loading dock through every single welding and testing station, all the way to final delivery.
Wow. So you simply cannot run a high-volume defense supply chain on, like, clipboards and spreadsheets.
No, absolutely not. Upgrading that software is honestly as vital as pouring concrete for a new building.
So what does this all mean? Taking a step back and looking at everything we've unpacked today.
With a lot to take in.
It is. We are really seeing a masterclass in opportunistic scaling. Graham Corporation is riding this absolute tidal wave of demand in naval defense and commercial space.
Yep.
But rather than just working their existing factories to the bone and hoping for the best, they are strategically leveraging customer grants to physically expand.
Which is incredibly smart.
So smart. They are utilizing institutional investments like the T. Rowe Price PIPE to clear their debt. And they are making smart acquisitions like FlakTech to secure new technology.
They are doing absolutely everything necessary to transform what could be a cyclical industrial business into a highly resilient, diversified powerhouse.
Exactly. And it highlights a crucial lesson for anyone trying to understand macro-industrial trends.
What's that?
Well, when you or I think about the modernization of naval defense for the future of space exploration, it's totally natural to focus on the prime contractors winning the massive headline-grabbing contracts.
Right, the big names.
But the real shortcut to understanding the physical reality of those industries, the actual pace of construction, is watching specialized mission-critical suppliers like Graham.
Because they are the ones actually bending the metal and building the infrastructure.
Yes. If their book-to-bill ratio is at 1.5x, it gives you a tangible read on how much heat and urgency is currently flooding the defense and space markets.
That is such a vital takeaway. It's about looking one layer deeper into the supply chain to find the real story.
Exactly. But I want to leave you, the listener, with one final, slightly provocative thought to mull over on your own.
Okay, let's hear it.
We talked extensively about how 85% of Graham's massive backlog is tied up strictly in the defense sector.
We did.
And right now, that is incredibly lucrative and fueling massive growth.
But it also represents a tremendous concentration of risk.
Exactly. Because think about the physical realities we just discussed.
Right.
These are factories built to exact Navy specifications. They're outfitted with automated welders tuned specifically for nuclear submarine components. If geopolitical tides were to suddenly shift in the late 2020s, or, if government defense spending priorities were to drastically change,
Which happens.
it does, how quickly could a company with so much hyper-specialized infrastructure pivot to commercial markets?
Oh, man. It is the ultimate double-edged sword of being a mission-critical supplier to the government.
Right. You build the invisible parts that manage the world's most extreme pressure, but eventually you have to wonder how much pressure the business model itself can take if the global currents suddenly change.
It really is a fascinating vulnerability hidden right inside a record-breaking success story.
Absolutely. Well, that wraps up our deep dive on Graham Corporation. Thanks for joining us.